All right, let's talk about the US tax code. Now, for most of us, it feels like this dense, super complicated set of rules designed to just take our money. But what if it's not that at all? What if it's actually a rule book for a game? A game with a hidden logic that once you get it, well, it changes everything. Okay, let's get into it. You've heard the stories, right? The billionaire who pays a lower tax rate than their secretary, or that high-income doctor who somehow ends the year with a tiny tax bill. It just seems impossible, maybe even a little unfair. But the real question is, how are they doing it legally? That's what we're gonna unpack right now. Look, the answer isn't some secret loophole buried on page 5,000 of a legal document. The secret? It's understanding what the tax code is for. See, it's not just about collecting revenue. It's actually a guide, a really powerful set of incentives that the government uses to encourage us to do very specific things. And that, right there, is where all the opportunity is. So let's try to reframe this whole thing. Think of the tax code less like a demand for your money and more like an offer for a partnership. The government's got this massive country to run, and it can't do everything by itself. So it basically says, hey, you help us hit our economic goals, and we will reward you with some serious tax breaks. And this isn't just some theory, you know? It's the whole principle behind the code. Every single tax deduction, every credit, every special rule, it's there for a reason. And that reason is to get us to act in a way the government believes is good for the country. So what does the government want us to do? Well, it wants people to provide housing, because it can't build all of it. It wants us to start businesses and create jobs. It really wants people to invest capital to keep the whole economic engine humming. When you do these things, you're not just an earner anymore. You become a partner. And you get to play by a whole different set of rules. And that brings us to maybe the most important distinction in the entire tax system. The code treats the money you make from a job completely differently than the money you make from investments or a business. And I'm not talking about a small difference here. It is a massive financial divide that determines everything. So there are two totally different paths here. If you're an employee, the order is locked in. You earn your income, the government immediately takes its cut through taxes, and then you get to spend what's left. Simple. But if you're an investor or a business owner, that order gets flipped. You earn income, then you spend money on business expenses and investments, and only after all that do you pay taxes on what's left over. That second step, the spend part, that's where the whole game is played. Okay, so if spending on investments is the key, how do people create these huge deductions? Well, one of the most powerful tools is a concept that sounds completely backwards, generating a loss on paper from an asset that's actually going up in value. The way this magic works is through something called depreciation. See, the government sees a rental property not as a home, but as a piece of business equipment, like a giant machine. And like any machine, it assumes the building wears out over time. So it lets you deduct a piece of the building's cost every single year as a business expense, even though you didn't actually spend any cash. And this is the part that is so wild. In the real world, your property is probably going up in value. But in the paper world of taxes, the government lets you claim it's losing value. You could have positive cash flow coming in from rent, your property value could be climbing, and you can still tell the IRS that you had a loss for the year. This paper loss is the engine that drives so much tax strategy. But it gets better. Smart investors kick this into high gear with something called accelerated depreciation. Basically, they do a cost segregation study that breaks a property down into all its little parts. Things like the carpet, the appliances, the light fixtures. All that stuff can be worn out or depreciated way faster, like over 5 or 7 years instead of the standard 27.5 years for the building. This lets them pull decades worth of tax deductions forward into the first couple years they own the place. The impact here is just massive. A cost seg study on a pretty typical $500,000 building can spit out a first-year paper loss of $120,000, or even more. That is a gigantic deduction that can wipe out all your rental income and then some. So, what do you do with all that leftover loss? This is where it gets really interesting for high-income professionals. Doctors, lawyers, people in tech. The big goal is to take that massive paper loss from real estate and use it to cancel out the income from their high-paying W-2 job, potentially just erasing their tax bill. But there's a catch. Yeah, the IRS doesn't normally let you do this. They have these things called the Passive Activity Loss Rules, or PAL rules. And what they say, in simple terms, is that losses from passive stuff, like most rental properties, can only cancel out income from other passive stuff. They can't touch the active income you make from your day job. For most people, this is a total roadblock. But there are ways around it. You could try to become a real estate professional, but that's really hard. We're talking over 750 hours a year. A much more accessible path for a lot of people is the short-term rental strategy. If your average guest stays for 7 days or less and you materially participate in managing the property, the IRS doesn't see it as a passive rental anymore. It's treated like an active business. And that means its losses, supercharged by that accelerated depreciation we talked about, can directly wipe out your W-2 income. This is the key that unlocks the whole thing. All right, let's switch gears and talk about the end game. Because these strategies don't just stop at lowering your taxes this year. The wealthiest families use the tax code to build and then pass down wealth from one generation to the next with almost zero friction. One of the absolute biggest moves is to simply never sell your best assets. See, selling triggers a tax bill. So instead, the wealthy borrow against their stock portfolios or their real estate. And since loan money isn't considered income, they get boatloads of tax-free cash to live on, all while their assets keep growing in value, completely untouched by capital gains tax. So what happens to all those decades of untaxed gains? Well, this is where maybe the single most powerful tool for generational wealth comes into play: the step-up in basis. When you inherit an asset, its original purchase price, the cost basis, is just wiped clean. The new basis becomes whatever the asset was worth on the day the original owner passed away. Think about it like this. Somebody buys a property for 300 grand. Decades go by and it grows to be worth $6 million. That's $5.7 million in gains that were never taxed. When they pass away and leave it to their kid, the cost basis steps up to $6 million. The kid can sell it the very next day for $6 million and pay zero, absolutely zero, in capital gains tax. All that growth is legally and permanently erased from the books. Just gone. So as we wrap all this up, the really crucial thing to get is this. The tax system isn't just one system. It's really a two-track system. There's one path for people who earn a wage, where taxes are pretty straightforward and kind of unavoidable. And then there's a whole other path for people who own assets and run businesses, the very things the government wants to encourage. Understanding all this isn't about judging the system. It's just about understanding the rules of the game as they're actually written. The tax code is an incredibly powerful tool for building wealth, but really only for those who know how to read the instruction manual. So the question is, now that you've seen the rulebook, which game are you going to choose to play?